Section 1. Understanding bonds loans that pay you back. Imagine loaning money to a large institution like the government or a company and receiving regular interest payments in return. That's essentially what a bond is, a loan you make to these entities. When you buy a bond, you're essentially lending them money for a fixed period. In return, they promise to pay you a specific interest rate on that loan, known as the coupon rate, and repay the principal amount when the bond matures. Think of it like this. You're the lender and the bond issuer, the government or company, is the borrower. You lend them your money and they promise to pay you back with interest. This makes bonds a form of debt security, as opposed to stocks, which represent ownership in a company. Bonds are considered relatively safe investments, especially when compared to stocks, because they offer a predictable income stream and the return of your principal investment upon maturity. Of course, no investment is entirely risk-free. The creditworthiness of the bond issuer plays a significant role in determining the risk associated with a particular bond. For example, bonds issued by governments of stable countries are generally considered very safe, while bonds issued by companies with a higher risk of default carry a higher risk. This risk is reflected in the bond's interest rate. Higher risk generally means a higher potential return, but also a greater chance of losing your investment. Investing in bonds can be a smart way to preserve your capital and generate a steady income stream. By carefully considering factors like the bond issuer's creditworthiness, interest rates, and your own investment goals, you can make informed decisions about incorporating bonds into your investment portfolio. Remember, bonds are just one piece of the puzzle when it comes to building a diversified and well-balanced investment portfolio. Section 2. Exploring different types of bonds. Just like there are various ways to lend money, there are different types of bonds available to investors, each with its own set of characteristics and risk profiles. Understanding these differences is crucial for making informed investment decisions. Let's delve into some of the most common types of bonds. Government bonds, corporate bonds, and municipal bonds. Government bonds are issued by governments to finance their spending and operations. They are considered among the safest investments because they are backed by the full faith and credit of the issuing government. Within government bonds, you have options like treasury bonds, which are long-term bonds issued by the U.S. Treasury with maturities ranging from 10 to 30 years. These bonds are known for their stability and are often used as benchmarks for other interest rates. Corporate bonds, on the other hand, are issued by companies to raise capital for various purposes, such as expanding their operations or funding new projects. These bonds typically offer higher interest rates compared to government bonds because they carry more risk. The risk associated with a corporate bond depends on the financial health and creditworthiness of the issuing company. Municipal bonds, or munis, are issued by state and local governments to finance public projects like schools, roads, and hospitals. These bonds often offer tax advantages, as the interest income they generate is generally exempt from federal income tax and sometimes even state and local taxes. This makes them particularly attractive to investors in high tax brackets. Each type of bond comes with its own level of risk and potential return. Government bonds, particularly those issued by stable governments, are considered the safest but offer lower returns. Corporate bonds offer higher potential returns but come with greater risk. Municipal bonds provide tax advantages, making them appealing to certain investors. By understanding these differences, you can choose the types of bonds that align with your investment goals and risk tolerance. Section 3. How bonds generate returns. It's all about interest. One of the main reasons investors are drawn to bonds is the steady stream of income they can provide through interest payments. But how exactly do bonds generate these returns? It all boils down to the interest rate, also known as the coupon rate, which is set at the time the bond is issued. Think of the coupon rate as the fixed annual payment you receive for lending your money. This rate is expressed as a percentage of the bond's face value, which is the amount you'll receive when the bond matures. For example, if you purchase a bond with a face value of $1,000 and a coupon rate of 5%, you'll receive $50 in interest payments each year. These interest payments are typically made semi-annually, meaning you'll receive $25 every 6 months. This regular income stream can be particularly beneficial for retirees or those seeking a stable source of cash flow from their investments. It's like receiving a paycheck from your bonds. However, it's important to note that the price of a bond can fluctuate in the secondary market, where bonds are bought and sold after they are issued. This fluctuation is influenced by various factors, including changes in interest rates, inflation, and the creditworthiness of the bond issuer. If interest rates rise, the price of existing bonds generally falls, as investors can buy new bonds with higher interest rates. Conversely, if interest rates fall, the price of existing bonds tends to rise. When a bond's price goes up, it's said to be trading at a premium, while a bond trading below its face value is said to be trading at a discount. Understanding how interest rates affect bond prices is essential for making informed investment decisions and managing risk in your bond portfolio.